Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Wednesday, May 24th, 2023. It's great having you with me today. We're going to talk about Fed in minutes. Yes, expectations continue to be day to day, right? The Fed is saying it's data dependent. They're both looking at a very tight labor market and elevated inflation. So what they're signaling to you is that they really don't think they've really slowed down the economy significantly to provide a loosening of inflation. And that's a little bit problematic here, particularly consider we see continued to good data on the inflation, I'm saying on the employment side of the equation, and a little bit better numbers when we see inflation. Did not get that out of the UK today. It actually went the other way, and housing was one of the culprits. So that sort of dentines the whole story here. Still, even with that, they're going to continue to reduce the investment portfolio at the same time holding rates at this level. They believe the toll that's being taken both on consumers and businesses is starting to take effect. February, March showed that. A little bit of a movement back up in April. Expect May to be somewhat weak because of the debt ceiling crisis that we're talking about out there. Businesses, the investment, manufacturing has continued to be weak. Services continue to be the upper push that we're seeing there in the economy. So net, a modest recession from the Fed and a modest recovery from that as we move forward. No rate cuts, but maybe one or two data dependent higher rates for the market as we move forward. But this is all dependent on the debt ceiling. Continue to think that we'll see some volatility over the next week or so. We saw a 6% print on the recent auction. That is telling us clearly market participants are worried. We still think something gets done, either a temporary extension or a more permanent one, or potentially just remove it out. Just it's not a big issue. Let the government, continue to issue its debt. It's part of the budget, and just work from there. So a lot of posturing that will go on there. Ultimately, should be solved. I think the market participants have enough in it, and enough of it's kind of theoretical, meaning that they're going to start talking points instead of actual budget items. We agree that this will be something in plan in the future, which of course means that in the future they could remove it. So how meaningful that is, I think again, we have to be cautious of it. But I think what we see in the Fed minutes is this surprise, maybe a little bit of shock, particularly on the employment side and how solid that is. And we cannot dismiss that because that's an important driver of the economy. When business people have jobs, they're spending money, and when they're spending money, that reinforces. So that negative feedback loop that we get with unemployment has yet to surface. Now, there are some regional elements. We're seeing some in the West. We see some in the Northeast. Those are percolating out there, but the South is very strong. And so if we think of something that's going to damper this party, it's going to be on the investment side. It's probably going to be in the residential side of the equation, still having shortages. An uptick. It's new homes were better, new home constructions were better, but I think we have more risks for the economy being stronger over the next couple of months, particularly if the debt ceiling crisis is relieved. I think there'll be sort of a relief rally coming from there. And then I think people are ready to go on vacation. People are ready to travel. People are ready to get out. There is still this sense of the trap that people felt during the pandemic and the eagerness to move out. And those elements are still, I think, going to continue to be strong, and travel, leisure should do well. Again, back to jobs, right? Because those are the elements that drive us going forward. Yeah, net, elevated inflation, this tight labor market would clearly signal more rate hikes ahead. I think the Fed is done here. I think they're kind of giving up the ghost in the sense of saying we really can't do much, and we hope that things will slow down appropriately and that some of the lack of spending, the decrease in the spending will have some of a pulling back function on the economy. But I think what we have to recognize is even the Fed's admitting probably a little stronger on those dynamics than we should be at this point after 500 basis points of hikes. This is Scott Murray for the Daily Economic Market Shop. Thanks for joining me.